Hey guys, welcome to the Bitcoin Fortress podcast, helping you stay humble and stack sats through every twist and turn of this crazy fiat world. Today is November 30th, 2025. We are at block height 925894. Moscow time is 1093 sats per dollar, and on-chain fees are 111 sats per VByte, about as cheap as it gets. Bitcoin just wrapped up one of its roughest months of the year, but also one of the most educational ones. Price whipsawed from the mid 120s down toward 80,000 and has been clawing its way back into the high 80s, low 90s range. November has been all about volatility, ETF outflows, macro fear, and then a late month relief bounce. In this episode, we will cover this week's Bitcoin and macro news from November 23rd through today, ETFs, mining regulation, and privacy tech, all the big structural stories behind the price, themes from the Bitcoin podcast universe over the past week, featured Substack posts, staying strong in choppy markets. Quick reminder about my three Bitcoin Fortress books, and finally, we'll wrap up with an encouraging outro to send you back into the chaos with conviction. As always, nothing here is investment, tax, or legal advice. The show is for entertainment and education only. Do your own research, verify, don't trust. All right, well, let's jump into the news. First, we'll talk about price action, volatility, and macro. Lots to talk about there. From Yahoo Finance, November is shaping up as Bitcoin's second worst month of 2025, with a drawdown north of 17%, driven by heavy ETF outflows and short-term holders puking coins. This is what normal looks like for a hard asset repricing against a dying fiat standard, folks. Short-term leveraged tourists are getting blown out. Long-term holders are barely flinching. And again, we'll talk about this later, but my choppy markets Substack piece ties quite nicely into this. CoinDesk talks about after hitting extreme oversold RSI readings with over 200 million in liquidations, Bitcoin bounced on November 23rd, hinting that sellers may have exhausted themselves, at least for now. Also from CoinDesk, by November 24th, Bitcoin had topped 89,000, up over 10% from the lows as broader crypto participated in a relief rally. Again, this is classic structure, cascading liquidations into thin weekend liquidity, then a sharp bounce. And when everyone's terrified, that's often when the bottoming process starts, not finishes. The real question is, are we in a bear market already? Or is this just a pullback and we are still in the bull market? Time will tell. But we don't care that much about the price in the short term. Zoom out. And time in the market is better than timing the market, as they like to say. Tinkerbell effect and sentiment narrative. So MarketWatch and Deutsche Bank analysts revived the Tinkerbell effect. Bitcoin works as long as people believe in it. They framed the 30% plus drawdown from the October all-time high as a crisis of confidence. So, folks, fiat analysts still don't get that belief is also what props up dollars, treasuries, and stocks. Bitcoin's belief is anchored in code, math, and 21 million, not political promises. And again, we have to contrast narrative, storytelling versus protocol, which just has a set of rules and just works. Macro winds shifting from flight to safety to rate cut hopes. So Reuters, last week's piece described Bitcoin on thin ice near 80,553, part of a broad flight from risk as investors feared delayed Fed cuts. But then on November 27th, Reuters said by this week, the tone had flipped. Stocks, Bitcoin edge up as investors bank on Fed rate cuts after softer macro data. Bad news is good news again, seems like. Some Bloomberg crypto news and Forbes article describe Bitcoin reclaiming the 89 to $90,000 range, and analysts warning of a possible Fed price earthquake if the policy stance shifts faster than expected. Bitcoin is still trading as a high beta macro asset in the short term, and we all have to remember that. That's just how the market has learned how to treat it. But the deeper story here is each macro scare moves more people from just speculation to maybe I should own some of this thing for real. Some articles on the post crash autopsy and November's Bloodbath. First, HackerNoon and Aurpay uh, posted several long form pieces dissecting November's bloodbath. Peak near 126 in October, trough around 80.5 in November, roughly $1.2 trillion. That's trillion with a giant T of global crypto market cap evaporated and billions in forced liquidations. This, friends, is the price of price discovery in a free market with no circuit breakers. Volatility is the mechanism by which Bitcoin pulls coins from weak hands to strong hands. Just remember, if you don't remember anything else, just remember that. And again, stay strong in choppy markets. We'll talk more about that later on in the podcast. Taking a look at ETFs, flows, and institutional positioning, as we like to do here every week. There were record ETF outflows and the first signs of stabilization last week. CoinDesk article: U.S. spot Bitcoin ETFs have seen a record 3.79 billion in outflows this month, surpassing the prior record from February. Ethereum products also bled, while weirdly, Solana and Ripple funds attracted capital during the meltdown. Go figure. Farside Soso Value dashboards data confirmed the persistent outflows earlier in November, followed by a few days of net inflows as price started rebounding. The Wall Street tourists used the ETFs as a liquidity exit, not a conviction entry. As I've probably talked about before many times, everybody gets excited when they're buying, but they will sell quickly so that they can lock in their profits and fear and buy themselves a sweater, whatever. But you also have to remember if they're selling, then somebody's buying. So those coins don't vanish, they just migrate to longer term hands and self custody. BlackRock and outflows are, quote, normal. Bitbo news snippet says BlackRock reportedly downplays roughly 2.3 billion in outflows from IBIT as normal in the context of volatility and profit taking. Again, institutions are learning you don't buy Bitcoin at all-time highs with leverage and expect a straight line up. The presence of huge players doesn't change Bitcoin's rules. It forces them to play by its rules. So is Bitcoin the Trojan horse or is TradFi the Trojan horse? I guess time will tell. But Bitcoin's rules haven't changed last time I checked. So, and everybody gets wrecked equally on the way up and on the way down, but patient hodlers, well, they seem to come out ahead. Next up, miners as a leveraged ETF proxy. Investors.com JP Morgan pieces. JP Morgan upgraded CleanSpark and Cypher to overweight while trimming targets for Marathon and Riot, framing miners as highly sensitive to the recent drawdown and bounce. So, mining equities are Bitcoin with leverage plus execution risk plus jurisdiction risk. So, keep that in mind. Over time, some miners pivot toward AI or data centers. We will talk about bit farms in a little bit, while others double down on mining and efficiency. So, if you like speculation, miners are probably a good choice. But if you just want exposure to Bitcoin, just buy Bitcoin, hold in cold storage. Institutional adoption narrative still marches on. This from AI Invest BTCC. Several pieces argue that November's volatility is happening alongside growing institutional interest, treasury allocators, asset managers, and platforms like Robinhood continuing to expand Bitcoin offerings. Investopedia highlighted Bitcoin's bounce to 88K and quoted Michael Saylor declaring, "I won't back down." The B, of course, with the Bitcoin symbol, underscoring corporate treasury conviction. The narrative gap price looks shaky month to month, but corporate and institutional infrastructure keeps thickening. And of course, if you're a corporate or an institution looking to allocate to Bitcoin, would you be more comfortable at a 30% discount, or would you be more comfortable at the all-time high? I don't know, maybe 30% discount. Again, fix the money, fix the world. Companies like Strategy are effectively forced to choose which asset to inflate against. Moving on to mining difficulty and the AI pivot. Mining difficulty set to rise again, according to BitBo. A fresh piece today notes Bitcoin mining difficulty is set to rise again, even after the price drop, which signals that miners remain committed and the hash rate is robust. And again, as I've said before, as long as Bitcoin remains decentralized and secure, we are good. The scarcity schedule doesn't care about November, and hash rate rising into price weakness is historically a bullish long term signal. Miners are playing the multi cycle game. China's quiet mining resurgence. According to Reuters, despite the 2021 ban, China has quietly clawed back to between 14 and 20% of global hash rate, with cheap hydro and data centers in places like Xinjiang making mining economically irresistible. You can't ban math, folks, or incentives. You could just push them underground. This reinforces why geographical decentralization and, of course, home pleb mining, which we've talked about here, still matter. We don't want any one jurisdiction controlling too much of the hash rate. Largest private gold holder shuts down mining. The Street slash Yahoo reports a fascinating story this week. One of the largest private gold holders is shutting down its Bitcoin mining operations, citing volatility and preferring to refocus on core bullion business. Old World Capital sometimes dips into mining for yield, then bails at the first serious drawdown. In the long arc of history, this reads like 19th century merchant gives up on telegraph because it's too volatile. Bitfarms pivots to AI data centers. This from Tech Radar. Major miner Bitfarms announced a strategic pivot from Bitcoin mining to AI data centers, planning over 1.3 gigawatts of AI oriented infrastructure and claiming future AI earnings will eclipse all past mining profits. This is the big energy story. Bitcoin miners have built out power dense infrastructure, and AI is trying to rent it. Possible future hybrid facilities where hash rate and GPU compute share power footprints, with miners flexing load based on margins. Next, let's take a look at regulation, politics, and geopolitics. First up, the Bitcoin for America Act and a strategic Bitcoin reserve. Lowenstein Crypto Brief writes about Representative Warren Davidson, who introduced the Bitcoin for America Act, allowing taxpayers to pay federal taxes in Bitcoin and routing those coins into a strategic Bitcoin reserve for the US government. Even if this never passes, the Overton window has moved from ban Bitcoin to maybe we should hold some. This is exactly the kind of nation state FOMO El Salvador has been front running. Congress's crypto to-do list. So from CoinDesk, a state of crypto piece notes that the Senate has restarted some crypto initiatives, but has very little time left this year to finalize anything meaningful. Stablecoin rules, market structure, and AML CTF issues remain unresolved. ICAEW analysis points out that the UK's FCA continues down its crypto roadmap, reiterating that most crypto assets are high risk and that final rules may land in 2026. Regulatory uncertainty is itself a policy. It keeps people nervous and dependent on legacy rails. Long-term clear rules may actually help Bitcoin by flushing out junk and reinforcing Bitcoin's separate commodity-like status. But at least in the United States, we're in a far better regime than we were just a few couple years ago. China's PBOC reaffirms its crackdown. This from Reuters. China's central bank reaffirmed its hardline stance on virtual currencies and stablecoins, stressing they have no legal tender status and promising a renewed crackdown on illicit flows, even as mining quietly resurges. The more authoritarian regimes scream, the more they signal Bitcoin's threat to capital controls. Hint, hint. The contrast with Hong Kong's more permissive stablecoin regime is probably worth pointing out here. But you can try to ban Bitcoin, but you can really only ban yourself from Bitcoin, and it will continue on. The Samurai Wallet founders were sentenced recently. The US DOJ put this out. The founders of Samurai Wallet, previously charged with running a Bitcoin mixing service, were sentenced to 5 and 4 years, respectively, earlier this month. This, folks, is a shot across the bow for privacy tools, and we all need to take this very seriously. It's important to distinguish, though, between the tools, which are neutral, and behavior, which can be criminal. But regulators often blur that line, and this will certainly have a chilling effect on developers who want to create Bitcoin privacy tools, which is really a shame because you should have the ability to have access to privacy tools um, in order to protect yourself from scrutiny. I guess the example would be you live in a house uh, with big windows. Um, do you want no curtains? Do you want everybody to see inside your house, or would you rather have some curtains? It's kind of like that. The majority of people that use Bitcoin are not criminals, but they do want privacy, and that should be respected just as much as property rights. There, I'll get off my soapbox now. Moving on, stablecoin risk and the Genius Act. Bank Policy Institute article, a briefing on the Genius Act, highlights that even fully backed stablecoins carry systemic risk and retail risk despite redemption guarantees. Thing to remember here is stablecoins are simply fiat wrappers. They're still subject to the same macro and counterparty risks that all fiat faces. Bitcoin on Lightning, however, or in self custody, doesn't have stablecoin issuer risk. It's a different risk profile entirely. And folks, there's a use case. Geopolitics, the $13 billion Black Ops hack accusation. So, from Bloomberg, The Block, and Disruption Banking, China has accused the US of orchestrating a $13 billion Bitcoin hack involving the Lubian mining pool. Follow up reporting frames it as a potential Black Ops operation. So, whatever the truth is, this shows Bitcoin is now deeply entangled in state level cyber conflict. And if you noticed recently, the top holders of Bitcoin nation state, with North Korea being on the list in the top 10 or somewhere, I forget what number they are, but well, that's basically state level cyber. That's how they got all their coins, basically. They're stolen. That's how all the government gets their coins. They're stolen from criminals or whatever. That's how they build their stack. So, not a great thing, but that's what's happening. But again, coming back to this article, this reinforces why self custody, decentralization of mining, and truly distributed infrastructure matter. Moving on to tech, lightning, privacy, and financial plumbing. We have the Van Eck CEO questioning Bitcoin's encryption and privacy. This article from CoinDesk, Van Eck CEO Jan Van Eck publicly wondered whether Bitcoin has, quote, enough encryption and, quote, enough privacy, name dropping Zcash as having stronger privacy features and raising quantum resistance concerns. Well, this is a nice tie-in with a couple of Substacks I wrote about last week, dealing with quantum threats, and the most recent one in particular on the Bitcoin Improvement Protocol 360, which is intended to address or begin to start addressing some of the quantum concerns. Again, Bitcoin's roadmap, Schnorr, Taproot, potential future soft forks, does allow for evolving cryptography without reinventing the money. So, and we certainly don't need to jump to a shitcoin to help us get through that. So, worth noting. Real world asset tokenization and the quote weekend gap risk. CoinDesk wrote a piece on tokenized stocks, warning that 24/7 trading of on chain stocks can misprice assets over the weekends, setting up arbitrage and liquidity risks when TradFi markets reopen. Again, Bitcoin is natively 24/7 trading asset. Traditional equities are not. Most of the buyers and selling tends to happen Monday through Friday during normal market hours. Friction lives at the bridge, not the asset. This is another reason why Bitcoin as base collateral has a structural edge over tokenized TradFi. But tokenized TradFi is coming. Make no mistake about it. So, um, don't be trading your tokens on the weekend unless if thinking that's the market price, unless the volumes are equivalent to what they are Monday through Friday, which I guess we will see when that day comes. Lightning Network momentum and stable coins on Bitcoin. So from the Voltage blog, 2025 saw USDT launch on Bitcoin's Lightning Network, enabling Lightning native stablecoin transactions and potentially outscaling Ethereum for global payments. Lightning Money Trail and node updates, articles, and Reddit posts covered Lightning node profitability, and the money trail of Lightning investments show a maturing ecosystem of routing nodes and service providers, which you love to see. Lightning is quietly becoming the payments layer for both sats and stablecoins. And this is a great opportunity to remind everyone here, not your node, not your routing fees. So get hands on. Moving on to nation states and long term adoption. Million Miner wrote a commentary piece arguing that nation state Bitcoin adoption could structurally transform global markets reshaping FX reserves and bond markets in the coming decade. From El Salvador's tiny balance sheet to the idea that the U.S. Strategic Bitcoin Reserve, or of the U.S. Strategic Bitcoin Reserve, the game has started. The question for listeners is not if countries adopt, but when and what cost basis. And of course, again, if you look at the top 10 list of nation state holders of Bitcoin, it's already happening. And how are they getting all those coins? They're stealing them from criminals. That's what they do. Or, maybe they'll get you to pay your taxes in Bitcoin or whatever, but you know, that's budget neutral accumulation in effect. Let's take a spin through the podcast themes of the week. Um, there's some clear meta themes: corporate conviction, Bitcoin is everyday money, censorship, and spam seem to come up. Uh, First up here is under corporate treasuries and $60 billion Bitcoin bet. We have an episode from What Bitcoin Did, the $60 billion Bitcoin bet with Strategy CEO Fong Li, which came out on November 28th. This episode was focused on how a public company is managing a massive Bitcoin treasury position, corporate governance, and why they're not backing down after the drawdown. The theme there is long-term conviction, sophisticated treasury management, and using volatility as an opportunity. Couple episodes from TFTC on Bitcoin as everyday money and merchant adoption. The first one, bringing Bitcoin to every Square seller in America with Miles Suter. That was TFTC 684. Block's 8-year journey building Bitcoin infrastructure across Cash App, Square, and BitKey. And again, quietly, millions of merchants now have a Bitcoin payment stack in their pocket. TFTC 686, Living on a Bitcoin Standard in 2026 with Steve Lee. This was a practical conversation on what it means to actually live on a Bitcoin standard: budgeting, volatility, cash flow management. And again, the Bitcoin lifestyle is no longer theoretical. People are architecting their finances around sats. It's not easy to do. I will be the first to admit that, but it can be done with a little bit of research and a little bit of work. Uh, On spam, censorship, and node policy, I think this podcast we talked about last week, Bitcoin spam, a Libre relay view with Kevin Kai on the Stefan Livera podcast. Uh, Talked about mempool policy, spam, why some attempts to block certain transactions create censorship vectors. Also, I think we talked about this last week, Bitcoin adoption in Mexico and Ario with Gustavo Flores. This was a ground level view of educating users in Mexico, local attitudes to inflation, and how Bitcoin fits into that context. Again, people seem to get Bitcoin that need it most, and people that don't need it the most are further away from understanding it. And finally, Bitcoin is collateral and historical narrative. A couple recent episodes on Bitcoin Audible. Thermodynamic monetary transition and ultimate collateral, as well as Forging Satoshi with Mark Hunter and Arthur Van Pelt. Themes here: Bitcoin as energy anchored money and ultimate collateral asset, and the importance of guarding Bitcoin's historical record and origin story against fraud and revisionism. So, if you only have time for a few pods this week, these are ones that should help sharpen your knowledge. Moving on to this week's featured Substack post. This week's post is called Staying Strong in Choppy Markets. If November has tested your conviction, this one's for you. First of all, some key points. Zoom out on the time horizon. Bitcoin's 4-year halving rhythm and long-term adoption curve make a single bloody month look small. Yes, I know it's hard to believe, but price is noisy, and the Bitcoin supply schedule, of course, is not. Next, anchor to a written thesis. Write down why you own Bitcoin. Inflation hedge, censorship resistant savings, long-term store value, etc. When volatility hits, go back to that thesis instead of refreshing charts. DCA and position sizing. You need to emphasize consistent stacking in your model and avoid leverage. If you're overextended, consider shrinking your position size rather than abandoning the asset entirely. Also, build resilience outside the chart. Focus on health, family, work, and faith. The things we've talked about in here, and of course in my Bitcoin lifestyle work. Use the bear periods to learn, build skills, and improve your setup, whether that be wallets, multi-sig, privacy, etc. And then, of course, curate your information diet. Mute the doom porn and the dopamine drip trading TikToks. Replace them with books, long form essays, and signal heavy podcasts. We can wrap this up by tying November's drawdown and the ETF outflow panic back to this essay. Um, this month was a live fire exam of the mindset that we've been teaching here on the Bitcoin Fortress. Before we wrap, a quick reminder if you're looking for structured education beyond the podcast, I've written 3 Bitcoin Fortress books. Bitcoin Fortress, a simple guide for beginners, plain English on ramp if you or someone you love is just getting started. Bitcoin Retirement and Estate Planning on how to integrate Bitcoin into long term planning, trusts, IRAs, and inheritance. Bitcoin Lifestyle, more about low time preference living, aligning your money with your values, and using Bitcoin as a tool to focus on what really matters. You can find all 3 linked in the show notes below and all on Amazon in many different formats. And what a perfect gift for Christmas for someone you love. All right, that's it for episode 192 of the Bitcoin Fortress podcast. We covered November's brutal but instructive price action, the record ETF outflows and early signs of stabilization, miners pivoting and doubling down, new regulation and geopolitical drama, and of course, the ongoing march of adoption from US treasuries all the way to Mexican startups and Square merchants. If November shook you a bit, that's normal. Just remember the protocol didn't change. Block 925894 looks a lot like block 100,000. Difficulty adjusts, blocks tick on, and 21 million remains 21 million. And of course, 1 Bitcoin still equals 1 Bitcoin. And of course, tick tock next block. If you enjoyed the show, please subscribe, rate, and share it with a friend who might need a little extra conviction right now. And don't forget to check out the show notes for links to everything we discussed, plus my books and the Substack. As always, stay humble, stack sats, take care of your health and your loved ones, and I will see you all in the next block. Bye bye.